So this is a stock that I've told myself so many times I'm going to take a look at, but admittedly it's just not as exciting as Lululemon, Shopify, Peloton, some of the other ones that I've looked at in the past, and some people might argue that no stock is exciting, but I feel that this is a very important one to have in your portfolio. So today we're going to take a look at 3M. Even if you haven't heard of 3M before, I'd be willing to bet you own at least one of their products or have in the past. Some notable brands that they have are Post-it Notes or Post-it, Scotch, not that Scotch, like Scotch tape, Command, NextCare, and recently the big one we've heard a lot about are the N95 masks. For a company with a massive variety of different products and brands, you might be surprised to know that they were actually started on accident. In 1902, the 5 founders were mining in Minnesota for corundum to produce sandpaper. After they started the mining process, they realized that they were actually mining a different mineral that was inferior to corundum and didn't have the same application that they originally anticipated. Now, instead of giving up though and just calling it quits, they decided to proceed and see what other applications this mineral they mine might be able to be used for. And they also started to look at other inferior minerals to see if they might be able to utilize those in different applications. And since they were able to utilize these inferior minerals, we now have the company that we know, 3M, and has really been a company that we need in today's society. So why am I taking a look at 3M? In an interview on a Bloomberg podcast called Masters in Business, Howard Marks said that the first question investors should ask themselves when building a portfolio or looking at what they have is, do they need to be defensive or aggressive? I feel the portfolio that I've been building each week through this video series has been moderately aggressive. We've had a lot of growth companies in there. We've also had a few safe investments. But I feel with current state of everything going on, I'd like to switch that into a little bit more of a defensive portfolio and one that can sustain any kind of downturns or roller coasters that we might go through in the future. Especially with this being an election year, I know that's going to increase the volatility come closer to the end of the year, come closer to election time. So I think it's going to be a very good time to have a few more defensive holdings in your portfolio. And 3M has proved to be more than essential in today's world. And they have a plan in place that will continue supporting us. I don't really have much exciting news from the earnings call this week, but one thing that stood out to me that they mentioned was in the 2000s when SARS was going around, they started to build what they called surge facilities. Basically, when pandemics hit, they had an extra facility in case they needed to step up production and be able to meet the demand for the products that they provide. And since then, they really haven't used the facilities all that often. They did once for H1N1, which, if I am not mistaken, is better known as swine flu. But now those extra surge facilities that they've built have really been important to them, and something I'm sure they are glad that they had in their back pocket. That was not easy to say. So if we put the numbers aside for a second, the thing that I really like about 3M is they're not focused on the numbers. They realize that the products they provide, for the most part, are a need. They're not a want, but these products are very essential to our society and ultimately could be essential to our own health and safety. And so they realize that we depend on them for a lot of things, especially in today's world. And they are willing to invest money in places that will help support the consumer, even if it's something that's probably going to hurt their balance sheet. So that's something I appreciate, because this is a company that's driven by the consumer, not by the numbers, or dare I say, even the investor. So I'm very appreciative that companies are looking out for the others around them and making sure that they have a plan in place to be able to support whatever gets thrown at them. So I do want to talk about their sources of revenue very briefly. I know a lot of the products that I listed at the beginning of this episode were more consumer-based products, but that actually makes up the smallest portion of their revenue stream. I'll pop this up on your screen. Certainly feel free to pause it if you want to take a deeper look at it. I pulled this right from their earnings report though, so you can also look there if you want more detailed information on this. But as we can see, safety and industrial is their largest source of revenue. Now, these aren't off by much. I know $1 billion is a lot of money, but for a company at this size, these numbers aren't really that spread apart. And the reason why I'm bringing all of this up is because I often talk about companies that have a more singular focus. So companies like Spotify, they are in the business of streaming audio. It's a good focus to have. Or companies like DocuSign, they focus on electronic signatures and document management. And this here is 4 different areas that they have a focus on. But the reason why that's important is because if you look deep into these, the applications that they use for each one of these different segments are pretty similar. And the best example that I would have for that would be in the safety and industrial category, Scotch painter's tape falls into that category. But in consumer, just regular old Scotch tape falls into that category. And ultimately, they're both just a tape. They're both an adhesive product, but they have different applications to them or different ways that they're used. So they've done a really good job of taking a similar application, but spreading that across multiple different industries. And ultimately, they've really shown that this product can be used in more than one way. You can even argue something like command strips. Those are another adhesive. So adhesives are not their only focus, but they are able to utilize different kind of sticky materials in so many different ways, which I think is a great business opportunity because they're not a one-trick pony. They're able to take that same idea, but spread it across different industries, and ultimately these are widely used across every industry. All right, so now let's move on to some of the numbers here. Now, I'm not comparing 3M to another company. I guess I could have compared them to a company like Honeywell if I wanted to, but I'll be honest, it's a company we're going to add to the portfolio anyway, and as I mentioned, one I feel is worth having for most people. So we're just going to take a look at 3M's numbers for this week. So if memory serves me correctly here, I believe this is the first time we have a PE ratio under 30, which is great to see. Now, of course, I have to mention, that doesn't necessarily mean that 3M is currently undervalued, but definitely doesn't mean that they're trading at a premium either. The earnings per share at about 8.52 is about exactly what I was expecting, so good to see that my thought process was in line with what their actual results were. I think the dividend yield is probably why most investors love this stock, with it being at 3.73%. That's a great number to see, and ultimately is something that, again, I think a lot of people get more excited about the dividend payouts than they do about Scotch tape. Also, they've been able to grow the dividend for 61 years, which is an incredibly long time. Now, I don't necessarily look at dividend growth as always a great thing. And we'll take it just a sidestep here. Walgreens, I think I've mentioned this before, just recently announced that they're closing a bunch of stores, they're firing employees, yet they're also increasing their dividend. Even as the investor, that's not something I love to see because what they're focusing on is maintaining that dividend aristocrat title. I don't think it's necessarily always about the titles that you have as it is more about the business plan that you have. So 61 years, great time to see them increasing their dividend, but I'm glad to know they're also able to increase their dividend without sacrificing employee salaries or shutting down different branches or anything along those lines. Now, the one thing that did concern me here a little bit is the dividend payout ratio. With it being around 72.5%, I thought that was incredibly high. What kind of calmed my nerves a little bit was the fact that they had the current ratio, I believe it was 1.65. So that made me feel a little better knowing that they can afford to pay this dividend. But I would say if this was a company that hasn't been around for 118 years, I would definitely be concerned and look more into that because 3M, while they still can grow, they're very well established. So they don't have as much acquisitions going on, or they're not building as many new plants or trying to get into new territories because they've already been established. I know it's been a really long time since I've done this, but I've actually have a free cash flow to the firm here for this week as well. It's not something I do often, and honestly, it's something I try to stray away from because when I make these videos, I try to make them more about the quality of the company than try to quantify everything. Of course, I do take a look at the numbers because that actually means something or has some significance to it. But when we start doing calculations to try to guess what the intrinsic value of a company is, I feel like we're starting to take away from what I'm trying to teach, which again is how is this company positioned against its competitors? What's its advantage? What products do they have? How do consumers feel about this company? And the numbers just eliminates all of that. So something that you'll probably start to see less and less of in the future. But for this week, I decided to go ahead and do one. So we're still using the free cash flow to the firm to do this calculation. I use a weighted average cost of capital to kind of do the present value, which is around 10.93%. So doing those calculations, I got an intrinsic value of $170.72, which I do believe is fair, but it's significantly less than what they're currently trading at. So that could be a good thing. Maybe my numbers are a little off here. Maybe I was a little bit too aggressive with my valuation for them, but I'm comfortable with that. And if we have the room to grow $13 a share for a company like 3M, on top of getting that, at just shy of $6 a year dividend, that's going to be cool for us to have in the portfolio. So let me go ahead. I'll pause the camera here. We'll add it to the portfolio, and I'll be back with you to review that. All right, so I went ahead, placed the order, and it's been executed for purchasing shares of 3M. Now, I do want to say, okay, I'm recording. Sorry about that. I do want to say I bought a little bit larger of a portion than what I typically do. And again, that's because I'm trying to switch this portfolio to make sure we have a good amount or good exposure to defensive companies. And so I went ahead and purchased, 35 shares of 3M, which came out to around $5,500. So again, a little bit larger than what we typically purchase. I've stayed away from doing the $5,000 each week, and I've kind of been doing more of like $1,000 per investment. But I'm happy with that amount, and again, I'm comfortable putting a little bit extra into a company that I personally feel isn't going anywhere anytime soon, and ultimately the dividend will pay out for itself. So that's now in the portfolio. Just a quick update too on how the portfolio is doing. So as of the time I took this screenshot, we were up $7,369.27 total. Fantastic to see, especially given that these times are volatile. As I've mentioned in the past, I'm not a day trader. I don't try to maximize profits. I try to build a sound and sustainable portfolio, and I think that's exactly what this portfolio is doing. As of now, the only company, with the exception of 3M, for whatever reason with this paper trading always takes a dip when I make a purchase. The only one that's at a loss right now is Verizon, and that's only down $55. So I think that we're doing a really good job with structuring this portfolio and making sure we have some winners in here. We do have some what I would call underperformers in here, but hey, having an underperformer is better than having a bunch of losers, so I'm okay with that. But I guess with all that said, it's all I really have for today in reviewing 3M. So I hope you found this helpful. This is the first video you might notice I am not including music in or have it in the background in a long time. I've gotten some suggestions to not include that. So I'd be curious to know your feedback or your input on if I should keep that going or if I should get rid of it. Also, I should note I got a free trial of Final Cut Pro, and I've been using that to edit my videos. So the sound volumes, I'm still learning how to adjust all of that, and thanks for bearing with me. But I'd love to know your feedback on, again, what I can do to make these more enjoyable, more entertaining, and if you like the music or if it's something that I should just completely get rid of. So let me know that in the comment section down below. If you enjoyed this video, I'd really appreciate if you gave it a thumbs up. Not going to say Graham Stephan style and smash it because I don't want you to break your computer, but a nice gentle thumbs up might be nice. Also, if you haven't subscribed already, I just ask that you consider doing so. But I guess with that said, you could be anywhere in the world and you're right here with me, and I really appreciate that. So thank you so much for taking the time out of your day to watch this video, but I will let you go ahead, enjoy the rest of your day, and I'll see you next time.